Oh, ladies and gentlemen, we have a good one. That's right. Why do I say good one? Obviously, I say it because look at this bad boy in the after hours trading. We're talking about Stitch Fix today. We're going to talk about this earnings release here. You see the reaction up 15% after hours. I'm not going to tell you I told you to buy the stock not literally, a week ago, but I did. Let's just be clear with each other. Let's roll the tapes back. I'm not going to roll them back, but you can. I'm just saying, stocks to buy. June, did you remember that one? That's right. Up 15% and 4% of the normal trading session. This thing went off today. Okay, let's take a look at these earnings and see what's going on with it. Why is it doing what it's doing? Well, overall, I like that. GAAP EPS of negative 18 cents, obviously expected. This is a company that doesn't post a profit. Beats by 8 cents. Obviously, I will say we dress up for Stitch Fix. It's you got to get your outfit right for a company of this nature. Okay, revenue line of 535 million. Fantastic number there. Up 44% year over year is a beat by 24 million. That's what I'm talking about. I really do like to see that overall number there. Revenue boosting 40% is beautiful, beautiful. As we get closer and closer, to the $1 billion mark. All right, this company's making it. Active clients of 4.1 million. It's an increase of 689,000 clients, or 20% year over year, and 234,000 quarter over quarter. So great growth there in terms of overall clients. You like to see that. Net revenue per client came in at 481, which is a decrease 3% year over year, and an increase 3% quarter over quarter. And again, this isn't a shocker. You need to consider this as you get a larger clientele. You're likely going to see a decrease in overall average revenue per client. And that's simple because not necessarily everyone's going to be spending the same amount. You'll get a lot of people that'll join the platform and buy one or two items or subscribe for only a few months. So that'll therefore lower your average revenue per client. So just consider that. It's the same thing in retail. Your average ticket goes down as your traffic goes up typically because you're adding in a lot more people that likely are buying a lot less. So consider that in mind as well. Now, quarter four outlook here. Looks like they're expecting 540 to 550 versus a consensus of 534. So nice there, 21 to 24% growth. And adjusted EBITDA 15 to 20 million with a 2.8 to 3.6% margin. For the full year, they're expecting 2.07 billion to 2.08 versus a consensus of 2.04. So a 21 to 21.5% growth, and adjusted EBITDA of 25 million to 30 million, which is a 1.2 to 1.4% margin. Now, one thing you got to consider, I think this is a company that really has the opportunity to boost this margin quite a bit. And a lot of that just depends on them converting a lot of their people who are using the service more of as a rental service. Getting more people to purchase the products could be pretty beneficial for them, but overall, that's a beat on all three aspects. So that's why you see the stock up. It's quite a significant step up, but you need to consider the fact that over the last really 3 months, or really closer to 5 months, the stock's been down nearly 50% from its 52-week high. So it's seen some unfavorable conditions. So that's why I think this thing's jumping up as much as it is. And they beat on all three aspects: top line, bottom line, guidance. They beat it all. Let's take a look at this press release. See what other good news we can find here. All right. Let's take a look. Quarterly highlights. We saw the revenue line. We saw the active clients, no doubt. Net loss came in at 18.8 million. Not too bad. We'll see what it compares to, obviously, versus the year prior as well. Not too bad. Adjusted EBITDA of 11.6 million. Highlights: high demand for our fixed offerings from first-time and reactivated clients that resulted in our second highest quarter-over-quarter client additions on record. That's fantastic. They increased success rates both year over year as well as quarter over quarter across the women's, men's, and kids category. Not a shocker there. They scaled the availability of Fixed Preview to the entire UK client base and over half the US clients with strong engagement, and approximately 3/4 of clients opting in, resulting in improved outcomes and higher average order values because people are buying the clothing after they try it out. They launched a shop by category to existing clients, enabling them to easily shop by department, trend, or their favorite brands. That's right. We saw the guidance. We like seeing that. Press release, usually pretty light on this one, so they don't mention a lot. We do have the balance sheet to look off of as well. I'm expecting some pretty decent things here. I would expect with a decent quarter, maybe we see some good stuff, but they give me a 6 months comparison, or a 9 months comparison in this case. Not too bad. I'll take a 9 months comparison any day of the week, okay? So, total current assets currently are sitting at $495 million. That compared to $466 of 9 months ago. So, there's some improvement there. Overall, looks like they improved more of in the inventory line, which is good because they can sell that stuff, right? Total assets at $833 compared to $769. So, good growth there overall. Would like to see liabilities not grow, but we'll see what we got here. Total current liabilities coming in at $264 compared to $212. We saw a little bit larger of an increase there than we did with the current assets. Total liabilities in general at $404 compared to $368. Overall is less of an increase than you saw with total assets. So equity looks like it increased $429 compared to $401. There's a growth here in terms of this equity, so I like to see that. And overall, the balance sheet's getting a little bit larger too. I could see it being a little bit bigger too. I'd like to see it grow just a little bit. I look at this stock and I take a look at it. Trading in a market cap of $6 billion for a company this year bringing in $2 billion, supposedly, according to their estimates. And it looks like they're going to hit that number just based off of, the first 3 quarters, undoubtedly. So I'm expecting them to do $2 billion easily. And based off of that number, trading at only a market cap of $6 billion seems a little cheap for me. We're talking about 3 times the value for a company that just grew revenue, let's say on average year over year, about 20%. That's good revenue growth, okay, for one. I like what they're doing there. That's revenue growth. Okay. Now, profitability is a standpoint that they need to work on. I can't lie to you. They can work on profitability and get there. But I think investors saw that the value wasn't necessarily fair. So that's why you see a 15% bump. I told you to buy the stock at anything below 60. It's at 66 right now. We'll see where it starts tomorrow. But I do agree, 60. Really, the 60 to 65 range, I think, is still a steal for this stock because the valuation just isn't fair to what it should be. This is an emerging industry, really. It's the future of clothing sales. And it's getting treated like it's, a little bit like dirt, okay? This valuation is treated like dirt. Have you seen the rest of the market? That's right. I've seen the rest of the market, and this is getting treated like dirt. That's what I got for you today. I hope you enjoy, and you have a swell day just like I am.